Well, most traders add about 5 to 6 indicators, as I have seen, and end up getting confused because too much of analysis is only gonna paralyze your decisions, or you might fear even taking an entry or an exit call. So they can now, as a professional trader, our main focus is to keep it very simple but making it more effective. The simple things which you implement will become the most effective tools to be used in trading. So today we are going to learn, as a professional trader, how to use an exponential moving average so that you never miss a trend again. So in this session, what we will be learning would be basics of exponential moving average. We'll cover the theoretical aspects of it. I would be splitting this video into two parts. One is the theory, and then we move to the practical aspects to see the charts and how to implement it. I would suggest not to miss the theory part because this is where the foundation lies. You should know what is a simple moving average, what is an exponential moving average, what is the difference between them, what is the reason why we are using it in the first place. Alright, simple, exponential. Then after knowing the basics, we will understand the basic settings, like which configuration we need to use. What are the 9, 21, 20, 50, 200. So what are the best settings which is available for an intraday trader, swing trader, as well as a long-term investments, that we would learn as well. And what are the 3 strategies which are very effective? It has given me results. Probably I can say 80% of the trades have been successful using these strategies. So you can also implement them after doing paper testing, of course. As well as we would go to the real chart examples and the mistakes which we must be avoiding and what instruments we can use using this exponential moving average. So stay with me till the end of the video so that you don't miss out on anything which is, although I mean it might seem minuscule to you, but if you miss out on few things, it would seriously hamper the outcome of the strategy. So welcome back. This is Mohiith Shankar, Trade Smart with Mohiith. I'm a SEBI registered research analyst. I post such videos, educational videos, every week, as well as I do show my verified P&L statement every quarter in this channel. So if you are very new to the channel, do consider subscribing it and click on the like button, as well as post in your comments so that I know that there are certain things which you are liking or certain things which needs improvement in this video. So let us directly go into the exponential moving average, the basics part of it. So when you click on the drop down, if you go to investing.com or any other chart site, and if you just click on the function button, you see two moving averages. One is an exponential moving average, the other is the simple moving average. Now what is the difference between these two and why are we inclined towards exponential moving average? This you should know so that you know the difference and you know what to use and what not to be used. The simple moving average, for example, if I plot the prices of a stock over the period of 5 days, say it is 100, 102, 103 or 104, or say I'm just putting a random number, 110. Now what happens in case of a simple moving average is that when it calculates the smoothing factor, when it uses the moving average, it just adds everything and then it divides by the number of days. In this case it is 5 to get a value for the 6th day. But if you have noticed here, the changes from day 1 to day 2, day 2 to day 3 have been marginal. But from 4 to 5, if you can see, there has been a change of 6 rupees, plus 6 rupees. Simple moving average just takes in the data points and then divides by the number of observations to give you the simple moving average. But what happens in case of an exponential moving average is that it gives more weightage to this 5th day. Say imagine that we give a weightage of 40% this day, and then I'm just randomly giving a percentages, and 20% to 10, 20%, 10%, 5 and 5. So if I just give a weightages like this, wherein I give more weightage to the recent observation, then it is more closer to the reality. For example, a company has got a big tender on the day 5, and which is going to increase its profit by say about 20%, then obviously this value makes more sense than, say, suppose here there was some negative news about the company, wherein the company reported a net miss in its sales, or probably might have got negative 5% in its net results, this does no longer hold good, or at least this deserves less weightage when compared to this news. That's the reason exponential moving average is more in line for an intraday trader or anyone for that matter. It gives more weightage to the recent news or the recent occurrence. That's the reason we use the exponential moving average. Hope it is clear now. I would not show the calculation part of it because that's not the scope of our video. However, if you are doing a CMT or a charter market technician, then we would probably delve into the calculation part of it. That series would come in later. So what are the best EMA settings? Now, if I want to tell about the best exponential moving average settings, we have already talked about SMA or EMA, because SMA is much better for an intraday trader. Clearly, because it gives more weightage to the recent occurring observation of the data. Now, what best EMA settings for traders? Now, we usually use exponential moving average as a pair of two lines. I will show you 9 and 21. This is the most common commonly used pair in case of an intraday trader. So if you are an intraday trader and if you want to make money, probably you are waiting, you need a reliable strategy which you can bank on day in and day out, I would suggest you to use 9 and 21. Some of them do use only 20 period moving average as well. So when I say 9 and 21, before you add this, the most important setting in your chart is the candle frame. Understand this, the candle frame, the candle time. Now, what should the candle should you be choosing? Say suppose if you're an intraday trader, stick anywhere between 15 minutes to 5 minutes candle frame. This is ideal if you are an intraday trader. Now, what happens if you are a swing trader? Probably you increase it to 30 minutes to 1 hour candle. If you are a 30 minutes to 1 hour candle, 1 hour to 30 minutes candle, this if you are a swing trader. Positional trader, just increase it to, just change it to 1 day. So this is for intraday trading, this is for swing trading, this is for this is for positional trading as well as swing trading, and this is for the long-term investments or long-term investments if you are looking at. So 9 and 21 is what we will be using predominantly for an intraday trader. What are the other combinations? I have also seen traders use a combination of 20 and 50 as well, but personally, I prefer 9 and 21 because I don't miss the early entry as well as the early exit if I am wrong. So that's the best combination according to me. You can you can do a trial and error method and choose the best combination which works for you. So 9 and 21 is good, and then 50 EMA, this exponential moving average, this you can use it for swing trading, and 200 exponential moving average, this you can use it if you are a long-term investor. Now I will talk about the importance of everything one by one. Now, so 9, 21, 50 EMA and 200 EMA. And I have already spoken about the charts timing as well. So if an intraday trader, just stick to 15 minutes and 5 minutes. Now EMA also acts as a support and resistance. Now how does it act as support and resistance? Let me give you an example. Now whatever we are learning here on a PPT is just the theory part of it. We would again go to the charts and try to explain. We will try to correlate. First, you need to understand the reason why we are doing what we are doing, and then we will go to the practical aspect of it. So EMA acts as a dynamic support and resistance. Exponential moving average acts as a dynamic support and resistance. Now, what do I mean by this? For example, if I am taking a 50 EMA, as I told you, 50 exponential moving average, and if you are a swing trader, suppose if you have bought a stock of, say, Tata Motors at around 400 rupees, you have bought a stock of Tata Motors, and which is currently trading above the 50 EMA, 50 exponential moving average. Imagine the 50 EMA happens to be at 360 rupees. This is the price point, this is the line, and now the price here is 400. So obviously, since it is more than 50 exponential moving average, your all the strategies should be on the buy side. Similarly, if it is below 50 EMA, then probably you might look for a shorting opportunity for a swing or a positional trader. Now what happens is that whenever I told you about support and resistance, say suppose the price is here and 360 is here, your ideal buy point will be, if you want to go long in the market, probably you want to see for support, you ideally wait for this dip 360 or at least near to it. if you buy this one, because you have a support here, probably you can keep a stop loss of 358 or even 350 and then wait for at least 10-20 points or whatever target you have preset in your trading system. So this acts as an ideal support system. For example, other case scenario is that suppose there is one stock. Imagine the same. I will take an example of Tata Motors. The 50 EMA, the 50-day EMA is at around 360, and now it is trading at 320. Probably you want to go short because it is below the exponential moving average 50, and according to this, if any price, if it is below the 50 MA, you are looking for a shorting opportunity. For example, so which is the best price so that your risk reward will be favorable is that probably you can short here 360, because the price point which acted as a support in the previous example acts as a resistance in the next example. So 360 you probably, or 358 you wait, this would be our shorting point. And what would be your stop loss? Probably at least 10 points above the 360 level, and then you wait for it to go down. So it acts as both support as well as resistance. The best way wherein most of the traders use this is 200 exponential moving average. Now if you are a long-term investor, and by thumb rule, you might have you switch on any of the TV news channels, any of the CNBC TV 18 or any business news channel, it says that the stock is below the 200 exponential moving average or 200 simple moving average. That also works in case of a long-term investments. Whenever you are going for a long-term investments in any stocks, just apply this thumb rule. Any stock wherein the price is above 200 exponential 200 moving average, probably you look for buying that stock. Now what would be the buy price? Understand, the stock prices always have a tendency of coming back to its median or coming back to its average price point. So if 200 price point, say suppose I'm just randomly giving an example, any particular stock, ABC company, if the 200 EMA is around 500 rupees, you wait till it comes to around 500, or at least where the support is. You have to check the support so that you enter. No matter whatever strategy you use, if your entry is incorrect, it will hit the stop loss invariably. Imagine there is one stock, this stock, it is now trading at 600, and because of FOMO, fear of missing out on a rally, on a good trade, you enter the trade at 600 itself, not waiting for the dip, and immediately once it comes 600, there is a profit booking and it drops down to 500. You exit here, but probably there are people who are waiting for the right entry and then they buy it here at 500. So you would have missed the opportunity of buying this. So what we need to do is that patience is the key when it comes to trading or investments. You always need to wait for a dip to go long. So ideally this acts as support as well as the resistance. Any stock which is about 200 EMA you want to buy, although most of the times it might reach or might not reach. It depends on the chart pattern. I'm just vaguely telling you this is the price point wherein we look to enter the trade, but there are other parameters as well which would look. For example, a simple support and resistance on a daily chart, which will indicate us what is the support and resistance points and how to use them. So 200, on broadly speaking, 200, any stock about 200 moving average, you might look for a buying opportunity. Similarly, vice versa, if any stock is trading below this 200 moving average, you might look at shorting opportunity. Say anything which is 500, which is now at 400, probably you wait till it comes to 500 to short this. So these are the combinations which you use: 50, 200, and then is 9 and 21. 9 and 21 most important for an intraday trader. I will speak about next. EMA crossover. When 9 and 21, we spoke about 9 and 21 combination. Now what is 9? 9 is called as a fast moving line, fast moving average, and 21 is called as a slow moving average. Yeah, this is also called as a fast moving average or a short-term EMA, and this is a long-term EMA. This is a short-term because this is all relative. For example, if I say 9 and 21, this becomes the fast-moving average, 21 becomes the slow-moving average or short-term average or a long-term average. If I say about 20 and 50, which is short, this is short or a fast-moving line, and this is a slow-moving line. This is all relative, 9 and 21, 20 and 50. So in this example, which is good for intraday traders, we are taking the 9 and 21 combination, and we would see how it works out. For example, 9 and 21 is 9 is a fast moving line, and 21 is a slow moving line. Fast moving line and 21 is a slow moving line. Now what happens is that if 9, imagine fast moving line I am showing like this in this in a straight in a continuous line, and 21 if I am showing like this in a dotted line. So what has happened here is 9 and 21. If the 9 cuts the fast moving line, cuts the slow moving line, it gives a bullish signal. You are supposed to be taking a buy call. Vice versa, if 21 is above, imagine 21 comes instead of like this, it just goes up and over 9, then it becomes a bearish signal. So fast moving line higher than the slow moving line, then it becomes a bullish signal. You can remember like this. As well as when the slow moving line is higher than the fast moving line, the crossover has happened, it's a bearish signal wherein you look for shorting opportunities. This we would see in the chart now. This is a trading view chart. The instrument what I've added is Nifty 50. This is a 5-minute Hikanashi chart. If you want candlesticks, I can also put candles, but I prefer using Hikanashi because it cuts the noise. This is a Hikanashi chart, as you can see here, and these are the readings 25-20 with 20 points interval. I have just plotted this. This is an intraday chart, and it's a 5-minute candle interval, as I've told you. Now if I go to FX or function key and just put exponential moving average, EMA, moving average exponential, click this twice, so you get one simple line which shows, if you can see here, it is the smoothing length is 9 and the length is 9. The style, I can change the color, but I prefer keeping it blue because it indicates that the fast moving line, if the cross anything above blue, it gives me an indication that I need to buy. Now I need to change it to 21. So what I will do is I will choose the second one and put input as 21, because we are trying to use a combination of 9 and 21. The smoothing factor also I would change it to 21. The style, I'm going to change it to a slow moving line. I will just put it as red and apply. Now what you see here is distinct two lines. One is a slow moving line, and other in this example it is 21. The other is a fast moving line, which is 9 period exponential moving average. I always say period because it depends upon the candle what you use. If I use a 5-minute candle, the period becomes 5. If I use a 15-minute candle, the period becomes 15 minutes. If I use a daily candle, the period becomes 1 day. So it is safer to say that I'm using a period candle. So for 9 and 21 combination. So according to this rule, what we have just explained was, if the 9 goes above, if you can see here, if the 9 crosses and goes above 21, it becomes a buy signal. Similarly, if 21 crosses and it goes above 9, it gives us a sell signal. Now where do we enter? For example, you have got a signal here, you need to be buying. Now how do I know that this is the right point to enter? Usually this is out of experience. I'm not quoting any text, but I prefer taking an entry into this after the third candle. For example, this is the first candle, second, third candle, I got a dip here. Obviously, I mean, I would not be able to exactly buy at the dip, but fair enough to say that I would at least buy at a lesser than whatever the highs it has been made. Small retraction I am looking for. Imagine that I bought it here, if you can see on the right side, 25.90. Let me draw that so that you know how much points we can make. See, this is 1, 2 and third candle. Imagine I have taken a trade. So 25.90, imagine that is our entry. If you can see here, the low is 25.88. Imagine that there is some slippages. Okay, fine, I'm discounting for the slippages as well. Imagine I bought it at 25,090, 95, or even in fact 25,100, say for example. I keep a stop loss. My stop loss would be below this line, below this slow moving average. Now below this slow moving average, in this sense, it is 25.84. At least 20 point, minimum 30 point stop loss we do keep in Nifty. So imagine my entry point is 25.90 and I keep a stop loss of 25.60. So what do? I wait for it to progress. I give it time for the market to expand, and here we got the target of 25,141, which is almost 50, 60, 50 points. 50 points, yeah, 50 points we would have got, and either you exit it or you hold it till you get the confirmation sign of the market reversing. Even if you would have exited here, you would have been at break even or at least made 10 points. But you enter with a preset target in mind, as well as the predetermined stop loss. Before these two, without these two, don't enter a trade. Now this is how we use the 9 and 21 combination. Similarly, suppose you expect that the markets are going to go down and you see this crossover happening. 21 is going above 9. So where do you enter? Again, 3 candlestick rule, because this I have been using this successfully in my day trading, so I prefer going with the third candle. Wait for the confirmation to happen. Even say suppose you don't get the entry, it's okay, just leave that day, because there might be chances of a fall signal which might happen if you don't wait till the third candle. Imagine what happens is that the second candle itself, the market again jumps above, then probably you would have entered at the wrong signal. So third candle is ideal, preferably Hikanashi, as I always tell you. Imagine we entered here. What is the point here? 25.95 we have entered, and imagine we get here 25.40. So again 60 points we would have made using this crossover. Now again, understand, no strategy is foolproof. There are chances of it failing. It's always a probability game. Trading is a probability game. So what you ideally need to do is that you go with a proper risk management. Without risk management, trust me, none of the strategy would work. In the sense, the strategy works, but you would not be there. You would not survive after 10 days because your risk management is not proper. Probably risk management I will make a separate video because that needs more focus than any of the strategy or indicators. If you agree with me, do post that in the comment, how risk management is more important than the strategy itself. So this is how we take we can enter in a bullish trade as well as a bearish trade. Now let us change this one. Instead of Nifty, let me put Tata Motors, as I have told you, or any other stock which you want to understand. So Tata Motors Limited, I have I have posted this. So 9 and 21, again you check on any of the volatile stocks, you would be able to use this 9 and 21 for an intraday trading. Now I would shift from 9 and 21 to 50. What I have explained it to you, I just go to 21 here, exponential moving average, and I just change it to 50. This is a simple. I'll just change it to exponential moving average. The smoothing factor I will change it to 50, and I will see. Now as you can see here, this is obviously is below this here. If you can see, this is below 50 moving average. Whenever it comes closer to this line, for example 696, here it is 693, it's fair enough to take a short trade here. Probably you would have ended up making 681. Again, post-mortem analysis is very easy. In retrospect, you can analyze anything and you can say that this strategy works wonderfully. You put that into use by yourself, do paper trading first and then put in the real money. This is how you need to be trading. So anything below 50 EMA, this zone, you try to see for shorting opportunities. Anything above, you try to look for long opportunities. Now here, if you can see, this stock has been in downturn for quite some time. Since I have taken a 50 period, let me change this into 30 minutes, because if I am a swing trader, it makes sense to change the chart interval as well. See, now it's more clear, because swing trading, you are likely to hold that stock in a short position. You're shorting it using futures or probably options. You are likely to hold it for a few days. Options, definitely, because you would not hold options because there is a time decay in options which is dangerous. So I am thinking that probably you are an investor, you want to enter the Tata Motors stock, probably this is not the price for you to enter. Now what do you do in case of a 200-day moving average? Now let me again add that as well, so that we can compare both 50 as well as 200-day moving average. Now this I'm going to change it to 200. Input style, you go to length 200. Smoothing factor, again I put as 200. Now this I need to make it more distant than this line, so I just make it as a red color, and I would see, okay, sorry, this even, in fact both are, I have made it red. So let me change this one into the fast moving line. I always prefer to keep it blue. Sorry, blue. Yeah. So this is a 200 exponential moving average, the red line. So the buying, it gives a buying indication only when the stock prices goes above this level. Now at present it is showing as 697. So unless and until it crosses 697, there is no bullish momentum. I would not take a long position in this stock. If you can see here, it crossed 705 and it is just going below. So probably you can use a combination of this 50 as well as 200 to understand. Okay, fine. What happens is that using 50 and 200, it determines the trend of this particular stock. 200 especially, the trend is bearish. You can at least know that, okay, fine, if you have some stocks you have shortlisted for your investments, for example, you want to hold it for 5 to 6 years, then probably this is not the right time to enter this Tata Motors stocks. Probably you can choose some other stock as well which fits, which clearly gives you a buy signal. So this is how we use 50 as well as 200. As I told you, see here 200, it is coming near. Probably you can buy in this zone, 683, and then again when it crossed here, when the price started crossing 705, you just have to exit. At least you would not have made loss. So this is how you use 921, 50 as well as 200. Wait for the retracement to enter. In case of a long term trading, always wait. The price always corrects. The prices doesn't move in one single straight line, so that would never happen. So always understand that always the market gives you an opportunity to enter as well as to exit. You need to know when to enter and when to exit. Timing in the market is challenging. We have already I have already explained it. One is a crossover, for example 9 and 21. You have seen a fast moving line crossing over the 21. That is a slow moving line, it's a buy signal, and vice versa is a sell signal. This we have understood. And then the trend is determined by 200 EMA, especially useful if you want to go long in any of the particular stock, or you want to invest in a stock and you don't know which is the right point. Probably if you can see an example of Tata Motors, which you have seen, unless until it goes above 700, there is no bullish signal. Probably you are better to avoid this stocks. If you are trading in futures, then probably you can short. But since futures has M2M, mark to market pricing, for example, even if you make loss, the money gets deducted from your account and it comes in lot sizes. It is a risky thing to do. Probably stick to the cash market, wherein you want to buy the Tata Motors. You wait till the price crosses about 200. It clearly determines the trend. 200 as well as 50, but most preferably trend is determined by 200 exponential moving average. The third strategy which we have used is the pullback entry. For example, the price is above 200 EMA. Imagine the same Tata Motors, if it was supposed to be at 795 and 200 exponential moving average is somewhere around 700. Wait at least to come, not exactly 700, at least 720, 730, probably your buying zone. It's a safe bet. Otherwise, the best of the stocks you can make, you can lose money if your entry is not right. So these are the three strategies which I have already noticed, which we have seen. And what are the mistakes to avoid? One is that, say suppose, most important crucial mistake in case of a day trader, which I have made a mistake and then only I have learnt it over this 12-year period, is that imagine there's a 9-day period and 21-day period. One candle crosses, I don't wait for the third candle. The chances of it falling, crossing again are there. It's always works probability. The trading is a probability game. So you need to have patience, wait for the third candle to enter. Always enter during a pullback and never enter in a rally, because once it starts falling, you might panic and you might exit. Although that the price wouldn't even cross 21 period moving average. So always wait. And the second thing what you need to do is that don't trade in the first 15 to 30 minutes of the day, because that's the period when the market is more volatile. And third is that always choose highly liquid stocks. Now, what are the highly liquid stocks to choose when you are using 9 and 21 period moving average? Would be a Nifty 50 stock. Use any Nifty 50 stock and do a paper trading at least for a period of 20 days. Why 20 days? Because 5 days in a week, trading days in a week, 5 into 4, 1 month of paper trading is a must. Don't lose the money. So unless try and test it out on a paper trading. If it works fine, at least 60 to 70% of the time your trades are going right, then have a proper risk management and then enter the trade with small amount of money to test it. So these are the main mistakes you need to avoid. Always wait for the confirmation, and always set up rules and just follow the rules. If you don't follow the rule, one fine day, even if one day you don't follow the rules, you probably overtrade. It might wipe out your trading capital, which will be suicidal. So these are the general mistakes which we do, which I have done, and which we all need to avoid this. Understand, trading is more of a psychology than any. If the trading were to happen only by assimilating the knowledge what you get freely nowadays, even if you get in ChatGPT or Google, then anyone would have become a trader. So it's not just about the knowledge, but it's more to do with the patience and discipline of it. Without patience and discipline, no matter whatever the best strategy you use, you would invariably fail in the market. So these are the things which you need to be using it. And so you have learned now how to use an exponential moving average. What is the entry, what is the exit, what is the trend? If there is anything else you would like to know, just put that on the comment section. If you have watched this video till now, do appreciate the video and the time taken by me to post this. And if there is anything else you would like to know, put that in the comments so that I can take it up in the next week's topic for you. Thank you, and you have a wonderful trading week ahead. Bye bye.